For a year, the dominant macro trade was simple. Sell America. The dollar was supposed to collapse. Tariffs were supposed to trigger capital flight. China was selling treasuries. Pension funds in Europe were trimming exposure. The story felt logical. America first. Geopolitical tension. De-dollarization. There was only one problem. The money didn't leave. It moved in. In 2025, foreign investors bought a net $1.55 trillion of long-term U.S. assets. That's up nearly 30% from the year before. $658 billion into equities. $443 billion into treasuries. $328 billion into corporate debt. That's not short-term momentum. That's structural allocation. While the narrative said exit, the plumbing said anchor. Now yes, China sold about $208 billion. Their treasury holdings are near the lowest level since the financial crisis. But that wasn't a rejection of the dollar. It was a reduction of dependency. China is de-risking from a system it doesn't control. That's geopolitics. But here's the part almost nobody covered. Europe stepped in. European investors accounted for roughly $873 billion of the net inflow. Despite tariff threats, despite political rhetoric, despite volatility, capital left stagnation and moved into scale. It rotated into liquidity. The deepest bond market in the world, the largest equity market in the world, the only AI-heavy index with real earnings power. This wasn't de-dollarization, it was consolidation. When stress hit the system, capital chose depth. It chose exit options. It chose liquidity. The Sell America trade failed because it confused headlines with plumbing. The system didn't fracture, it rebalanced. The world can criticize the United States, but when it allocates capital, it still buys it. Liquidity is the final vote, and in 2025, the vote was plus $1.6 trillion. This is Global Notes by JP. If this helped you see the board more clearly, comment, like, share, and hit the bell. We're building the strongest macro community on the platform. One signal at a time, together.